So you found a good trade, you took a good trade, but you just didn't get enough out of it. How many of you guys can relate to that? We all can. And in this video, I'm going to show you how to maximize the profits in your trades, because finding trades is one thing, but now can we actually ride that trade to our predetermined profit target? Can we actually squeeze the most amount of money in that trade? So in this video, I'm going to show you several different strategies on how you can manage the trades you're taking to try to get the most out of it. The easiest way to think about it is most people are trading like a chicken, but you got to trade almost like a turkey. You got to let that turkey get fat. You know, you're taking these skinny little chickens and you're not getting the most out of your trade. So in this video, you're going to learn 3 to 4 different strategies on how to maximize the potential out of the existing trades that you're already taking. Let's dive in. But before we go into the strategy number 1, I want to preface that by saying you're going to learn all these different tools in this video, but I want you to find the right one for you. How do you know what's the right one for you? A, can you realistically see yourself doing it? What good is a management strategy if you get jittery, if you get nervous, if you don't have psychology in order, if you haven't read my new best-selling book, Mastering the Trader Within, right? You're not going to be able to hold on to the trades. So learning all these fancy strategies is amazing, but can you actually do it, right? And you have to find the right strategy for you that ties in with your personality style. Some traders like to take the quick wins and do it over and over and over again. Some traders like to be disciplined and just manage the trade to get the most out of that. And there's no right or wrong. You have to find your right personality type. Now, let's say you found the right personality type, or you're saying, Anmol, I don't care. I will get myself to do it. I'm psychologically strong. Just give me the best strategies. How do I know which one's the right strategy for me? Then step 2 is back testing. And I'm going to refer to that towards the end of the video, so stay tuned. But now let's jump into strategy number 1. Strategy number 1 is 5-minute bar by bar. What does that mean? So first you enter the trade with your entry. You put your stop loss in the system. And when a 5-minute candle closes, you raise your stop loss under that 5-minute candle. Now you don't do anything. Let the trade play out for another 5 minutes. Another new candle opens, stock's going up in your favor. You raise your stop under that candle. And you keep repeating that process until you get taken out. Now that's a great strategy because not only is it protecting your profits as the stock goes in your favor, but if the stock keeps going, you're giving it the potential ability to actually go hit the target. Most people end up selling their trades too soon. They end up taking tiny little profits, and that is not a recipe for success. So that is strategy number 1. 5-minute bar by bar. Really efficient, really easy to do, and anybody can follow it. In fact, we have automated softwares that just do that for people that can do it for you. But again, anybody here can do it. Just wait for 5-minute candle close, raise your stop loss. Next 5 minutes, another candle opens, raise your stop loss under that candle. And I typically put it 1 cent under that prior candle. All right. Now let's go to strategy number 2. Now this strategy is probably the toughest one to do, but for me, I've seen that it actually makes a lot of money as long as you're really good at picking the right charts and the right trades. This is called the end of day hold, which is you enter a day trade with your entry, you put your stop loss in the system, and then you just don't do anything. Literally, you don't do anything. You walk away. You come back 3:55 p.m., 5 minutes before the markets are closing, and then you exit the trade, right? That is a strategy number 2 too, because how many times have you seen you take a trade, it closes with a full big green candle on the daily chart, and you just wish, man, I wish I was in that stock. Wow, look at that stock, put in a big, I wish I was in it. Now, if you were doing an end of day hold, chances are you would have been in it. And somebody who was doing a 5-minute bar by bar, he would have also made a lot of money, but chances are he would have got taken out as the stock pivots, pulls back, does a buy setup, and then the stock goes back up again, right? So the end of day hold is another great strategy that can maximize profits as long as you are taking good trades. So if you constantly notice, man, I take amazing trades, they always seem to work, I just get out too soon, maybe that's a strategy for you to look into. All right, now let's go to strategy number 3. This is called the 5-minute 9 EMA Trail. Okay, now there's 2 different ways we can do this strategy. So I want to give you the regular way and then a variation way, which I like. So regular way is you go on your 5-minute chart and you put a 9 EMA, which is a 9 exponential moving average. Now, why do we use exponential moving average? Because a simple moving average is going to be, quite behind the stock. Whereas the 9 EMA exponential moving average pays more attention to the recent price action. So it actually hugs the price closer. That is really important for day traders because I don't know about you, but I trade a lot of stocks that are gapping up or gapping down. We call it the gap strategy. So when a stock is gapping up, the moving average might still be down over here on a simple moving average, whereas a 9 EMA is actually going to be hugging the price pretty closely. Now, here's the only thing you got to do. As long as the stock is above the 9 EMA, you do nothing. You take your hands and you sit on them, right? Don't touch your keyboard, don't touch your mouse, let it go, and just ride the 9 EMA on a 5-minute chart. As long as the stock is above it, you're going to keep holding. As soon as the stock breaks that 9 EMA, you sell it, you take your profit and get out. That is another great strategy to manage your trade. And that's a strategy that I personally did all the way from 2013 to like 2016. Like I literally did this strategy and I had probably my best years day trading. So a really good one to look into. Now let me give you a variation, which is the same thing, 9 EMA, but with a little bit of a twist. Now in this one, when the stock breaks the 9 EMA, we're not getting out. We're going to wait for that 5-minute candle to close. And as soon as the new candle opens, then we put our stop loss 1 cent above that original candle that broke the 9 EMA. And oftentimes what happens is this candle breaks the 9 EMA, right? New one opens, goes right back up, and then you put your stop under that pivot and the stock resumes the uptrend, goes back above the 9 EMA. Now again, same exact process. As long as it stays above the 9 EMA, you're going to stay in the trade. And eventually you'll notice you'll break the 9 EMA again. And then guess what happens? You wait for the candle to close, new one opens, put your stop 1 cent above that. That is a really good strategy because it also protects your profits that you already have. So if you're somebody who's scared of giving back your gains, well, then this protects your profits as well, but also gives you the ability to ride a power trend. Now, what is a power trend? A power trend is when a stock is basically hugging the 9 EMA all day long. And again, I'll put up some examples over here that you can refer to. That's what a power trend looks like. And there's nothing better than you being in a power trend, riding it to the promised land. All right. Now let's go to strategy number 3. This is the easiest one to do, okay, but also the hardest one to do. Now, why do I say that? The easiest because, well, it's super simple. You just put your orders in your platform. You can put it as soon as you take the trade. And then once it's triggered, there's nothing for you to do, okay? This strategy is called all or nothing. Now, all or nothing, as the name suggests, it's all or nothing, meaning you pick a predetermined target. The predetermined target for most people is 2R or 3R, aka 2 to 1 or 3 to 1. What does that mean? Let's say I take a trade. I have a 30-cent stop loss. Well, 2 to 1 is 60 cents. 3 to 1 is 90 cents. So if I'm risking 30 cents on the stock, my target's going to be 90 cents or 3 to 1 or 3R. So let me give you an example. So let's say I buy a stock at $100 a share and my stop loss is $99 a share. So what am I risking on the trade? We're risking $1 per share. So then I simply go ahead and put my target for $103. Why? Because that's $3 per share. So 3 to 1 ratio, right? So when I do that, guys, you need to be right only 30-something% of the time and you can still make money. You could take 10 trades and lose on 70 of them. Even if 30 of them win, you're going to make money. Why? Because 70 times 1, you lost 70, right? And then 30 times 3, you made 90. Net, what did you make? You made 20. So that's how you make money being right 30% of the time. You can lose 70% of your trades. I mean, that's mind-blowing, guys, because, take a wall. You could put sticky notes on this wall and, on the sticky notes, write down Tesla, Microsoft, Google, all the stocks, right? And you can throw a dart. And whatever the dart lands on, whatever sticky note it lands on, you have to buy this stock. Guess what? You have 50% chance, right? What the dart landed on, it could go up or it could go down. You got 50-50 odds. And in this strategy, you only need 30% of them to go 3 to 1. So that's a really good strategy to do as well, is 3 to 1. But now I mentioned, what are the cons, right? There's always a drawback. There's no sure thing in trading. So what's the drawback of this strategy? The drawback is, well, you could have a stock, if you're going all or nothing, then there's no management involved. You're not touching the trade. The downside is it could go 2.9 towards your target and you never got out because you're looking for 3 to 1. You're now messing with the trade and it could potentially come all the way down, and that happens. It's part of the game. It happens all the time. But the problem is, as a professional trader, I know it's part of the game. I look at my odds. It doesn't matter what that trade does. I look at a sample size and how the strategy works. But for newer traders, when they see the stock go like 2.9 to 1 and oh my God, it came all the way down, I'm losing money on this trade, they can't believe it. And it frustrates them. Their psychology gets messed up, right? They haven't read Mastering the Trader Within. I'm going to keep plugging it in. It's the Amazon bestseller, by the way. So 3 to 1 is a great strategy to do. Pros, no management involved, super easy to do. You can put a bracket order on your software. And I'm going to show you over here what a bracket order looks like. As soon as you get into the trade, you put your entry, you put your stop loss, you put your target, and in one click, it does everything for you. So if the stock automatically hits your target, it'll cancel your stop loss. Or if the stock goes down and takes you out for a loss, it'll cancel your target order. It's called a OCO, one canceled another, or AKA a bracket order, because you have your stop, you have your target, and it's a bracket. And the software does that automatically. So pros and cons to every strategy, but it's a really great one to do. And you could play around with this strategy, guys. You can do 2 to 1, you can do 3 to 1, you can do 2.5 to 1. You can even set up rules if you want to be a little bit more advanced. Is, hey, if the stock does go 2.9, I'm at least going to go my break even. At least I'm going to bring my stop to break even. So now I know at least it's not going to be a losing trade. So there's many different variations that you can test around with it. So those are 3 amazing strategies that you can do. And all of these strategies, guys, have variations involved. What if I did a 2-minute bar by bar instead of a 5? Now the trade is going to be a little bit tighter. You might not be able to get the most out of the trade, but you're also protecting your profits. What if instead of a 5-minute 9 EMA on Mole, I did a 2-minute 9 EMA? You can do that too. Same pros and cons. There's always a trade-off. The looser the management, the more potential you have to make money, but then the more you have to be psychologically in control because the stock could also come down. The tighter the management, the lesser your ability to ride it to a profit target, but it's also going to be going up with your price, so you're not really going to give back your profit. So that's where I mentioned the personality. That is where it comes in. Okay, so now let's sum this all up. Trading is like a puzzle, okay? You need the right strategy, but then you also need the psychology to execute on this strategy. We could have the best psychology, we could have the best strategy, but if you never let the stock actually go to your target, you're never going to make money. So this is where money management comes in, risk management comes in, trade management comes in. That's what creates this trading wheel. If one part of the wheel is broken, it's not going to work out for you. I know so many people who are great money managers, great trade managers, they have amazing strategy, but their psychology is a mess. They end up giving it all of their returns back. They don't end up making it in this business. Then I know people who are amazing mindset, but the strategy sucks. So the strategy is horrible. A good psychology is not going to fix a horrible strategy. And then some people, they have the strategy, they have the psychology, but they never manage the trade. So that's why I said it's a wheel. You need all pieces of the wheel to come together for it to work for you. Okay. Now, I'm going to go a little bit more advanced. This is something that all of my traders are required to do. Otherwise, I will refuse to work with them. And this is something that 90% of the traders don't do. So if you do this, it's going to give you advantage over 90% of the traders out there, which is tracking and back testing. When is the last time you know or heard of somebody who runs a business and they don't do their books? Never. At least not a good business. Or how many times you've heard people run business, but they never collect the receipts? Never, right? Every good business collects receipts. They collect data. They have their accounts, they have their books done. But as traders, I ask traders, okay, let me see your last 100 trades in a spreadsheet. Let me see everything you did. I don't have it. I didn't track it. I'm like, so you're running a business and you don't want to track things? How's that going to work? You could be tweaking the wrong thing that doesn't need to be tweaked. So you can only do that when you have data. That's a successful foundation of any business. And yes, trading is a business. Okay, so you have to track your trades. So here's what I want you to do. Again, those of you who actually want to do this seriously, if you do this, you will get the result. And if you don't do this, that's okay. But then again, your results will show you the truth, right? And trading is black and white. We can say we know all these great things about trading, but our account will tell us the truth. Look at your account size. Is it going from point A to point B? If it is, you're doing the right thing. If it's looking like an EKG monitor up and down, well, that shows you the truth right there. So tracking is really important. So here's what I want you to do. I want you to go back and take a look at your last, I'm going to make it easy for you. Go back to your last 30 trades, right? Because last 100 trades, maybe you're like, oh, I don't even remember. Go back to your last 10 or 30 trades and write down on a piece of paper or on a spreadsheet, what if all of those trades I did 5-minute bar by bar? What would I have made? And what did I actually make? So what did you actually make versus if you just did that? How much would that have made? And then on the same exact trades, what if on the same trades I did 5-minute 9 EMA? What would I have made then? What if on the exact same trades I just held it till the end of the day? What did that make? What if I did 3-1? What did that make? Now look what it does for us. Now we can take a look over our last 1, 2, 3, 6 months of results and say, wow, I took 150 trades. And 150, if I just did 2-1, I would have made X, right? And if I did 3-1, I would have made X. And here's what I actually made myself. So then you will know which is the best management strategy for the type of trades that you're actually taking. And then now, my friend, you have become the casino because now you know your odds. Now you know the numbers. At the end of the 100 trades, I can roughly expect 60 of them to work, 40 of them are not going to work, but net, here's what I'm going to make. And if you just going forward, you do the exact same strategy on every single trade going forward, next 6 months are going to look pretty much like the last 6 months, right? Pretty much. There's going to be a plus or minus difference of 10%, but it's going to be roughly in that ballpark. But here's the thing where people are going to mess up. But Anmol, this trade's different. This one, I feel like I'm going to take 2-1. My strategy does 3-1. I said I'm going to do 3-1. I tracked in my back test 3-1, but this one, I feel like the market's tough. I'm going to do 2-1. And guess what happens? You get out at 2-1 and you see the stock go 3-1. Now, if you do that, every week, every month, at the end of 100 trades, now you're going to be behind that strategy. So that's why the foundation of trading is not to mess around, not to use your own mind or your own emotions and make decisions on the fly, but just test a system. And then your only goal as a trader is to execute and follow that system every single time, same exact thing on every single trade. That's how you get out of the rut of, I thought, oh man, I knew the stock was going to do this, but why did I get out too soon? Why did I get out? Because now you're only going to judge yourself based on how closely you followed your trading plan. You're not going to judge yourself based on what I made or lost on the trade. Anybody can make or lose on a trade. Broken clock is right twice in a day. You will only judge yourself based on, here's what I said I'm going to do. Again, person of integrity, right? Here's what I'm said I'm going to do. I'm going to do 5-minute bar by bar. And here's what I actually did. And it should be exactly the same. So hopefully this video was helpful for you. Hopefully you have some insights on how to manage a trade for a longer target. And I know it was a lot. I gave you a lot of things to think about, but your decision is going to be very easy as you go back and you take a look at your last 100 trades. And for those of you who are like, I didn't even track it, that's okay. Start now. Starting today, track all of your trades for the next 3 months and write down in a spreadsheet what each management made. And after 3 months, whichever management made the most money, that is your new trading plan. That is what I want you to do. And 3 months later, I want you to bookmark this video, come back in and type in your results for me. And I will be happy to see that.